Hey there everyone, welcome back to my channel. This is where we learn about money, we learn how to make money, and yeah, just some other financial literacy stuff that you won't necessarily find in a textbook. Today we're going to talk about something that's going to affect all of us everywhere we go in life. We are going to get to do with what we call insurance. It's something we don't really like to pay, but when something bad happens and we can claim from the insurance, then we are glad that we do have that insurance. Right, so before we get into the detail, there's something that I want to be very clear on, and that is the difference between insurance and assurance. Okay, now there is a difference, and I'm quickly going to explain it to you. Insurance is what we call when we insure something or for something that might happen. Okay, something bad that might happen. There's no guarantee that it is going to happen, but in case such a bad thing happens to us, you do have that insurance to compensate for your losses. Okay, assurance, on the other hand, is something that is definitely going to happen. All right, no matter who you are, where you live, uh, there are certain things that will happen in your life. And sorry to be so blunt, but eventually all of us are going to die. Okay, so an example of assurance will be life insurance, also known as long-term insurance. Insurance, on the other hand, normally they refer to it as short-term insurance. Okay, so now that we have the clear difference between those two types, we can go into short-term insurance. Remember, that is when you take out insurance on something bad that might happen. There's no guarantee that it is going to happen to you. Right. Now, insurance itself can be further divided into two groups, namely compulsory insurance and non-compulsory insurance. Okay, now when it comes to compulsory insurance, there are three types that we get here in our country, which is South Africa. And the first one is what we call UIF, which stands for Unemployment Insurance Funds. Okay, now that is exactly what it says. It's insurance for when you become unemployed, you can still claim a part or a percentage of your normal salary. Okay, now how it works is part of your deductions from your salary, a small percentage goes for that insurance, and then your employer also contributes to that fund, that unemployment insurance fund. Okay, so if you become unemployed for whatever reason, you can claim for up to 6 months unemployment insurance. Okay, 6 months maximum. Right, so that's the first compulsory insurance, is unemployment insurance fund, or UIF. All right, the second one that we have here in South Africa is what we call the road accident fund. Okay, so that is basically a fund that serves the purpose of the road accident fund is to compensate for people who get injured in road accidents, whether it's pedestrians, cyclists, people driving cars and buses and trucks. If you get into an accident on the road, you can claim from the road accident fund. Now, how do we contribute to that fund? Every time you fill up your car at the petrol station, a part of that price per liter, and by the way, our price on petrol is very high at the moment. In fact, it's quite possibly the highest that it's ever been. But part of that price per liter is your contribution to the road accident fund. So ask your parents, maybe you have a car yourself, you are already contributing to that fund. All right. And please, let's not get into any accidents, people. Please stay safe out there. Right. Then the third and final form of compulsory insurance is what we call, in short, COIDA. Now, COIDA stands for Compensation of Occupational Injuries and Diseases Act. Okay. So it's a law in South Africa. And your employer is responsible for keeping you safe in the workplace. Okay, so how it works is your employer contributes to this fund. Well, not really a fund, it's more like they pay for the insurance that should you get injured or pick up a serious illness at work, then you can claim for that illness or injury or whatever it is, which one applies to you. Okay, so those three are compulsory insurance that you cannot, I can almost say, bypass. Okay, everyone's got to pay it for it from your salary deductions or some other way. All right, you haven't got a choice. It's compulsory. Then you also get non-compulsory insurance. Now this is your choice. And there we have the normal short-term insurance. Okay, insurance that you take out on your car, insurance that you take out on your house, protection against a fire that might break out somewhere. You can insure your business. You can insure money in transit. You can insure losses that you got from negligence or from your employees, or in other words, fidelity insurance. Okay, so there are a number of different examples for non-compulsory insurance. But now my next question is, how do you contribute to that? Now here's how it works. You've got a profile with an insurance company. And every time you claim from that insurance company, you become more and more of a risk for them because you're costing them money eventually. Now, the higher your risk is to them, the higher your contribution per month will be. And we call that contribution a premium, okay, or an installment. So that amount that you pay every month is mostly based on how much of a risk you are to that company. If you are a responsible person, you take care of your belongings, you've got security cameras around your house, you've taken all the necessary steps to protect your possessions, then you won't be as big of a risk compared to someone who leaves his doors of the house open and doesn't really care about looking after his things. So the chances of that person being robbed or becoming part of the crime stats in our country is much higher than you, the responsible one. So that's why it's only fair for you to pay less of a monthly installment or premium compared to the other one that's a little bit less responsible, I could almost say. All right, so one last thing that I want you to remember and to take note of when it comes to insurance, and it almost sounds like a cliche, but there is a lot of truth in it. So it is to read the fine print. People, so many times, people have been caught out because they did not read the terms and conditions of their insurance contracts, aka the fine print. All right, so I hope that you now understand insurance better. Just to recap, remember, insurance is something that might happen, something bad that might happen, okay? And assurance is something that's definitely going to happen. All right. Stay safe until we see each other next time. Take care. Goodbye.